Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
With that sort of brief look back and look ahead in terms of factors which are important, let me welcome in Andrew Holland, who's with us right now. He's with Avendus Capital Alternate Strategies. Andrew, thank you very much. Appreciate you joining in and thanks for your time. We spoke with you on the 8th of June, our last conversation. At that point, you said that you can't get excited about sort of markets at current levels. Has that changed at all, Andrew?
No, not at all. And I just listened to your kind of introduction as well, and I can't remember what positive point you made about the factors affecting markets both here and globally. So I'm sure you commented on many times, but the index is being led by a very small majority of stocks, and once that party is over, then where does the index really go? Because the laggards really don't have much weightage, to support the index. So we're just sitting around, kind of waiting for the penny to drop. That there's quite a lot of things out there which should be a lot more scarier to the markets, but it's just not happening. And I'm still of the view that there's from our perspective in India with the oil price, yes, it's come down a bit, but I think the fundamentals still mean that the oil price is going higher going forward, because if you listen to what the Fed chairman's saying, he's saying growth is good, inflation's picking up, and the only thing he's worried about is a trade war. So that's the only thing which would kind of uncouple the markets. But whichever way I look at it, it's kind of negative news, because a growing US economy means interest rates have to go up, despite what Trump likes or dislikes. And of course, if you've got trade wars, then that could put the economy globally at risk as well, which would obviously have a big impact on emerging markets. So it's kind of heads you lose and tails you lose on both growth and any kind of slowdown.
Andrew, you were saying, well, you couldn't really decipher any positive points that I made. Actually, yeah, I mean, true. Negatives outweigh positives. But you just look at prices, right? I mean, the S&P 500, it's kind of sort of continues to march on. I was mentioning that important level it's taken out. You look at the other big variable, especially from India, oil, is down 8% over the last 2 weeks. Momentum-wise, it's headed lower. How does that fit in with your view?
So I think the S&P is still way below the January highs, and I think that's the key point here. Despite all the good news that you've got, with Trump and the tax reductions in the US for corporates and individuals, that's kind of played out. The increased oil prices probably meant that a lot of that money savings has gone into paying more at the petrol pump than it has into buying goods. But that said, retail sales is still very strong. So, global growth and US growth is still there. So, that's what's keeping the S&P a little bit higher at the moment. And of course, you're really factoring in that people are thinking that the trade war is not going to happen. And it's really, a lot of rhetoric from Trump, and they'll come to the table at some point. But, my view is slightly different, is that, who's going to blink first? And I don't see the Chinese doing it. So I think we're going to have to go all the way to something more severe than where we are today, and I don't think that's going to hold up well for markets. As regards the oil price, at the moment, if as we are today, then I think it's really more technical than it is the fundamental part of it, because fundamentally the supply demand is still favouring demand, and of course there hasn't been a lot of investment in exploration over the last 4 or 5 years. So if global growth does continue to pick up, then I'm afraid that oil prices are going to go towards that 90 level pretty quickly from where we are today.
What happens when the dollar yuan, onshore or offshore, hits 7 as a level? Is that going to flash red all over? I mean, how will that be red for markets?
Well, how it was read previously, and was that obviously it makes Chinese goods a lot more cheaper, and therefore they can dump a lot quicker into the European markets where there's no trade barriers at the moment, and obviously it's still attractive for you know, even US companies to buy from China. So another 10% depreciation from here is going to be huge. It's like, you know, it's really, you know, taking some of those trade barriers away. So, you know, they're playing a nice game here, and that's why I'm saying that, you know, who's going to blink first, and I'm not sure who. Someone has to at some point. And until we do, then we're just going to, you know, run into these kind of bouts of concerns over the trade wars and what that could happen in terms of the in terms of the global economy. But for sure, a trade war is going to be very painful, and it's going to be very painful for emerging markets, including India.
Okay, fair enough. You know, last time we spoke, which is about a little over a month ago, you said markets will differentiate between good quality and poor quality mid-caps. At that point also, I mean, the focus essentially was on this huge pressure that mid-caps and small-caps were facing. It's only gotten worse. Where is that differentiation already starting to get made, Andrew, in your eyes, or not yet?
Not yet, unfortunately. I think, you know, every stock's kind of being, you know, put into the same boat, and obviously some of the better quality companies, you know, are seeing a little bit more selling pressure because obviously there's maybe more liquidity there as well. I think maybe after this month, and maybe towards the end of August, it's very difficult on the timing. Maybe the mutual funds will have done their kind of reallocations and so forth and so on, along with the SEBI guidelines, and that will ease things off. But I don't see that again, I need to kind of look at mid-caps and small-caps at the moment. I just let the market do what it has to do. And if you missed, you know, the first 5% on some of these stocks, then it's okay. It's, you know, in the longer term run of things, it's okay to miss that first the buy at the bottom type of approach. So I think there's still more pain to come, particularly if global markets sell off. Then I think you'll see a lot more pressure on the mid-caps and small-caps.
You know, how is the market, in your view, reacting to earnings? Let's talk about the big earnings which came through the week, right? I mean, Bajaj sold off in a big way, actually. I mean, there's Bajaj Finance then. I'm talking about Bajaj Auto, which sold off in a big way. Bajaj Finance, strong numbers, good performance this week. There was RBL, Kotak, Mindtree. Ashok Leyland was a big one, down 18% this week. Is the market, I mean, the bar quite high for outperformance given where valuations are? And maybe that's the right way to react to these earnings.
Yeah, it's a kind of a reverse of last quarter, right, when I suppose expectations were quite low in terms of earnings. So, you know, that if you met or beat expectations then you were rewarded very well. But since then, a lot of these stocks have continued to move higher. So I think the trend we're seeing now is that if you meet, then, you know, there's profit taking, you know, in the very short term. If you beat, but you have to beat by a wide margin, that's when you get a little bit more upside. So I think the market's not rewarding as much as it did last quarter because valuations for a lot of these stocks are very high at the moment, and I think that's where we are. And as we said, that, you know, it's only 4 or 5 stocks which have led this market, and it's not necessarily because their earnings were great.
Okay, so where, you know, last time we spoke, you were talking about FMCG, private banks. You also interestingly mentioned that corporate CAPEX type stocks could start to look interesting. Again, we've not seen any evidence of that, Andrew.
No, it takes time. You know, I looked at the ABB results and the order book, and margins are looking a lot better. So now whether that's across all the capex type companies, it's difficult to you know, kind of put a broad brush on it. But it takes time. You know, I looked at the ABB results and the order book, and margins are looking a lot better. So now whether that's across all the capex type companies, it's difficult to you know, kind of put a broad brush on it. But I'm a little bit more encouraged by what I'm seeing there. But you know, it's not going to be an overnight story. It's going to take a little bit of time, and you know, this is going to play out over the next 1 year. I say it's probably worth kind of looking at them now. I'm not saying that, you know, you need to wholeheartedly kind of jump in, but I think nibbling away is probably the right thing to do at this time of the cycle for India. You know, given that capex will have to start to increase given where capacity levels are at the moment in quite a number of industries. That said, with quite a number of acquisitions being made through the bankruptcy laws, and some of that capacity is being taken by companies, so maybe that capex cycle gets just delayed a little bit longer than maybe we were hoping. But I think where valuations are, they're worth looking at the moment.
How will you briefly mentioned acquisitions, but in a different context. There are two large acquisitions which I think should come our way pretty soon, announcements. We reported that Hindalco is considering an acquisition in the US, some $2.5 billion worth. Markets didn't really react very favorably to it. The other one is UPL, where the size of the acquisition actually is even larger if it were to happen. Broadly, I mean, speaking, of course, these are individual businesses, etc. But where are these acquisitions coming in terms of the cycle itself? Are they coming in right at the top? I mean, what's your sense?
Well, not knowing the kind of details of the acquisitions themselves and what price to pay, you see, this is where you are. If you're making overseas acquisitions, you've got to say, where are we in the cycle? And I think we're probably towards the back end of the kind of cycle now, and if anything, by 2020 you'll start to see that kind of turn down as interest rates continue to rise. So maybe that's what the market's not liking, is making offshore acquisitions unless it's completely great value in terms of what you're buying, because of that worry that the top end of the kind of investment cycle globally. And particularly if you have any trade wars, it's going to be very painful because obviously commodity prices would take a hit under that scenario, which they have been doing actually over the last 1 month or so.
Fair enough. So, I mean, to wrap up, Andrew, any specific opportunities? We know what you like. I mean, corporate capex, private banks, consumption, IT. I mean, the usual stuff. But what should be the mindset really? Protect, preserve what you have, or be opportunistic? What's the frame of mind you have at this point?
So opportunistic is fraught with danger at the moment. I mean, I've one of my favourite sectors to dislike is pharmaceuticals, and it had a bit of a run and has been hit hard again because of the problems that they keep facing. So I think for this month and going ahead, it's really it's going to be really just hunker down and just let the markets do what they have to do. I think trying to second guess the markets at this point is just going to hurt you, and I think it's been hurting a lot of people. I've just come back this week from watching England in the World Cup, and there's more excitement there than I can feel in the market, even though you said at the beginning that we're near to highs. The pain below those 5 stocks is huge. And it's very evident.
And broadly speaking, you believe that the broader market will drag the large cap indices lower, and it won't be the reverse. It's not as if the Nifty is going to pull the rest of the market up with it.
Well, it hasn't done, really, has it? I mean, if you look at it, it's there's only 4 or 5 stocks which are really helping. Yeah. And so the kind of Nifty 50's lost one of its zeros, I think, or the only zero.